Hey everyone, welcome back to another episode of Investment Physics. Before I start with today's topic, disclaimer, I'm not a certified financial advisor. I'm just an engineer who's learning all these things out of curiosity and trying to share my knowledge. Please do your due diligence before taking my opinion seriously. So previously, I had spoken about trading with emotions and that whenever there is a crisis or a recession or something like that, always stay invested and that it will eventually even up. Especially if you're in a developing country with a growing economy, the stock market always goes up. All these facts hold true, but I feel that I have not done enough justice to give you an counter examples. Because sometimes you might feel that it's kind of the end of the world or the stocks falling. It could like lead to undue stress and panic. So I want to give you examples of what are the worst things that have happened in the past to give you an idea to prepare for the future. Um, the number one thing I want to talk about is the dot-com bust of 2000. So in the US at that time, the internet was a rage. People were just checking out about all these new e-commerce sites. Amazon and Google were just founded in that period. And this gave to like a whole new hype. Just like we have AI and ChatGPT now, just like there was Bitcoin and Dogecoin and other things a few years ago, it was the start of the internet era, e-commerce era. There were a lot of startup companies who were just going IPO, getting public money, and then they did not have any working product, no profits, no business model even. All they were doing is like building a software engineering team, going IPO, getting funding either from venture capitalists or from the public themselves. Um, this, of course, led to a massive bubble, and every bubble has to burst because the primary reason for a business to exist is to make profit. If there is no profit, it's not going to survive for a long time. Let me show you some charts of what things looked like in 2000 and what happened later on. So this is the NASDAQ 100 chart. This is basically an index for US tech stocks. It's very heavily dominated by the tech stocks. You can see that in 2000, the stock price was, or the value of the index was around 5,000, like 4,000 to 5,000 a share. And then the dot-com bust happened. The dot-com bust also happens in waves. So you can see that from like March to June or July 2000, there were like small ups and downs. But I think starting from November 2000, there was a massive drop. Um, this is another thing with stock markets. Whenever things go up, it takes its time to go. But when it falls down like a rocket or a falling knife. So if you see that things suddenly fall like this, it can lead to panic. And then after the 2000 crash, to reach back that level of 5,000, it was somewhere around here, like in 2015-ish. So for almost 15 years, the stock price or the value of the index did not recover, and all the tech companies had a very negative rap. Of course, the ones who survived this period did make it big. Amazon and Google are the biggest ones, and they definitely still are the largest and kind of profitable companies of today. But if you were an investor who bought the Nasdaq 100 and you lost almost all of your money and you had to wait for 15 years to get it back, that could definitely spook some investors, honestly. Let me show you another counter example. So this is the 2007 housing crisis. This was it was not because of overvaluation of any particular sector. It is because of the subprime crisis. What that exactly is takes some more length in explanation, but uh, Okay, to give you a gist, let me just tell you that there were some banks, they were doing very greedy things with the way mortgage loans are issued in the US. They were basically giving out loans to everybody, even very bad creditors. And some people bought 9 or 10 homes and they had no salary or income to justify it. Most of the people who bought the homes were assuming that they will get rent and they will use the rent to make the payments for the home. And the banks didn't care because all they wanted was to sell as much as loans as they can. uh, they did not hold any risk for themselves. Why that is again a different topic. I'll probably do a separate video on it. So this led to this massive bubble, and around 2007 here, again there was a massive drop. So in 2007, um, I think, yeah, November 2007, the value was 1500. The lowest point of this crash was in 2008. So it roughly took 1 year for the whole crash to happen. And then to reach that 1500 level from 2007, it took like 2012. So you can see that it almost took 5 years. And in the previous case, it took 15 years. Um, so the most recent one, the 2020 COVID crisis, it lasted barely a few months. And that is because the Fed has learned from all these past mistakes and they know how to use the interest rate to stop massive recessions from happening. Um, Again, why that happened or why this did not happen in the past is a different game. But all I'm trying to say is there have been recessions in the past that lasted for 7 to 15 years. And this is something every investor should be prepared for when you're coming into the equity market. So then, of course, the next question you would ask me is how can I identify this? Because if I have some way to tell that this is about to happen, like a apocalypse, probably I will pull out of the market at the right time. There is, of course, no easy way, and it is very hard to time markets, especially in recessions. There is a popular quote that the analysts have predicted 100 of the last 90 recessions accurately, which means everybody is always saying that there is some recession coming because of this, that, that. So you cannot really trust the news when you read that somebody says that there's going to be a recession, but still there are some reliable ways. Let me show you. So the number one way to predict a recession is something called as the PE ratio. The PE is the price to earnings ratio. I will not go into too much detail of what that is again because of time. But basically just know this, if the PE is too high, it means that something is overvalued. If the PE is low, it means that something is undervalued. Um, High could be anything above, let's say, 50, and low could be anything below 20. These are just broad numbers. It again depends on the specific stock, specific sector, the type of the business they're doing, and all that. I'm just giving you very generalized numbers of what is a high and what is a low so that you can understand fast. So this article shows what was the PE ratio for Nasdaq in the 2000 period compared to the S&P 500. The S&P 500 has a lot of other stock like banks and infrastructure and everything, but the Nasdaq has more tech stocks, and that was why you see that the P ratio of the Nasdaq was way higher compared to the S&P 500. It was in the 150 range. And when something like this happens, like you see that the PE has gone way beyond its average over the other years around it, then you know that probably something is brewing. It's like a calm before the storm, you know. Um, Let me show you another graph for the S&P 500 as well, which shows the historical P ratio. So here you see that in the 2000 period, the P ratio was not really that high. But in this 2009 period, it went up like quite a bit to like 120-ish here. Like this was, I think, in June 2009, it reached the highest of 120. That kind of coincides with what was happening in the housing crisis, but not exactly. This is more like a lagging indicator, and I don't think you could have used this to protect yourself from whatever was going to happen in 2007. But still, it kind of tells that there is something brewing. Um, but I understand that you may not be a person who sees these kind of charts and tries to make sense of it. So let me give you an easy way to tell if there is a recession about to happen. Whenever you see the stock prices go way high, way high, then it probably means that something is about to happen bad. I got this intuition from my father-in-law. So he was in the US working as an engineer in the 2000 period. And he said that every day some stocks used to double in price every day or every week. Like that is not normal. There is no way a company's valuation, earnings, or profits would double every week for the stock price to go up that drastically. Um, of course, it is hard to take this to heart because whenever stock prices goes up, everybody is happy. There is euphoria, but that is exactly when you should be scared. This is also reiterated by Warren Buffett in one of his famous lines. Whenever everybody is greedy, be fearful, and when everybody is fearful, be greedy. So you always have to think contrarian. Like if everybody is happy and everything is going so well, but there are no fundamentals to justify it, there's clearly a bubble and something is going to burst soon. Um, and then, of course, the next question you would ask me is, okay, you kind of spooked me now by saying that there could be a recession for 15 years. What am I supposed to do? Should I not invest in stocks at all? No, that is definitely not what I'm trying to get at. The most common strategy to handle this kind of a thing is always have some money in CDs, FDs, or bonds. These are usually reliable and more secure forms of asset storage. And whatever interest you get from those, you can continue to invest in equity. Of course, I cannot give a cookie cutter answer for this because I do not know your financials, I do not know your lifestyle. But usually, if you are a young couple with a husband and wife who have been employed in the past, there is a high chance that both of you will continue to find work. Of course, when there is a recession, you may lose jobs, but probably within a year or something, you might get jobs again. When you get jobs, please use that money to continue buying the stocks because if you do dollar cost averaging, like even from 2000 all the way to 2015, if you had invested money every month continuously buying the Nasdaq 100, you would have still broken even way before. Like you did not have to wait until 2015 for you to start making a profit, for you to be in the green. Um, but of course, I it may not be possible for everyone. Another case that might apply to some of you is some of you who are closer to retirement. Like you may not have 15 more years of work career left. Probably applying to retire in the next 3 or 5 years. For such people, most financial advisors recommend to reduce their exposure to equity and go more towards the bonds. Even in the equity, they usually recommend things like buying dividend stocks and very safe bets. There are a couple of things like Verizon, AT&T, Coca-Cola. All of these stocks, they don't go up a lot. They also don't fall down a lot. And they usually pay like 2 to 3% dividend per annum. So it's like you have some exposure, but not too much. And you always have some money left in your bonds and CDs and FDs. And you can use the interest from these to buy into your recession to make some profit whenever things go up again. But if you are a young person who has definitely more than 15 years of career left, I would say you can bravely invest in stocks. Just be sure, do not panic when the recession happens. Stay invested. Keep buying every month, no matter how bad it seems. Because, like I said, if you're in a strong country with a strong government, growing economy, things have to come back up over time. Um, I'd like to point out to some people who were able to successfully navigate the 2000.com bust. One such person who is still rich today is Mark Cuban. He has featured on Shark Tank. So he made this company called broadcast.com, which kind of got acquired by Yahoo in 2000 for $5 billion or something like that. He was also working in a hedge fund previously. So he kind of understood how bubbles work and how valuations work, and he had an idea that he was in a bubble. But because he was just acquired by Yahoo, there was some contract between them that he's not allowed to sell his stocks for 6 months. So what he did is he went out and bought a lot of puts for millions of dollars so that he could at least hedge some of his losses. That if there is a crash within that 6 month window, he will not be losing all this money. And when that 6 month window ended, he cashed out and he he still is rich today. So there are also a lot of Indian tech entrepreneurs in the 2000 period who made their own tech companies. They got IPO, they got the money, and they successfully cashed out. A lot of such people have still stayed rich today. But there are also people who thought that the markets will recover sooner than the 15-year period. And they did not do the dollar cost averaging. Like they were too spooked by the steep fall that they did not continue buying. And they, of course, had to wait 15 years, and that was probably not the smartest choice for them. Um, the same thing also apply to Indian investors. So let me show you the Nifty 50 graph. So Indian markets are considered as the child, US markets are considered as the parent. Whatever good or bad things happens in the US markets usually happens in the Indian markets as well. In the 2000, there was not much of a steep fall, but you can see that in the 2007 period, whenever US had a housing crisis, even India had a similar thing. It fell all the way till 2009 or 10, and then again it started recovering. And same thing here in COVID. During 2020, there was a steep fall, and then it started recovering. So what you can do if you're an Indian investor is just track the US markets as well, see the valuations and the P ratios of S&P 500, NASDAQ 100, etc. If you see something looking, like a bubble, then probably the same rules apply to you. Maybe you can pull out the money, maybe you can stay invested and buy through the dips, maybe you can reduce exposure. You have to find your own strategy, but it's probably a omen is all I'm trying to say. There are still some overvalued tech startups in India today. The popular ones are Byju, Zomato, Paytm, and Ola. All of these are very similar to the 2000.com bust in the sense that they have a product, but they do not have any profits. They do not have any cash flow to justify the stock price or the valuation. A lot of these companies also got money from US investors in the 2020 because US had very low interest rates and there were a lot of foreign institutional investors who were pumping money throughout the world. Now the US has increased interest rates because of inflation, and all that money is coming back, and these companies are not able to survive because they never had a profitable business model to start with. So if you're an Indian investor, please stay away from Byju, Zomato, Paytm, Ola. I will definitely go into more details of what is P ratio, what other ratios to be considered, how exactly to value a company. Please stay tuned. If you find value in my content, please like, share, and subscribe. If you really love my content, please hit the bell button too so that you are notified immediately as soon as I create a new video. Your likes and views are what is motivating me because I'm just trying to share knowledge. I don't do paid promotions. I never plan to. I'm just trying to share whatever I know to whoever is curious. Thanks.